All right. Hello, good evening again. Welcome back. Um, yeah, I think we still have a few or quite a few people that's probably on the way to class. But let's kickstart today's lecture. Hope everyone's doing well. We are more than halfway through the module already. So hanging there. We still have after today, two more lectures and we are almost to the finishing line. All right. Um, so just to follow up from the last lecture, recall that at the end of the lecture, we're trying to solve some problems. So just want to highlight that in case you did not know, I've actually uploaded a new set of lecture 3 slides. And this new set of slides include the solutions, um, workup solutions, particularly for the self-review examples. So, I think there was some wrong answers that was provided. So now I actually verified answers. And in case you're still practicing those questions, do download the new slides for lecture 3 so that you can double check whether you're on the right track. Okay. So, let's do a quick overview of what we have covered so far, right? So recall at the first lecture, we did the qualitative description of how we value a company, right? So this module, the purpose of this module is to value a company. And perhaps now, as you are doing your GBA, that's what you are required to do a full valuation report. And of course, if you notice, you look at the past year's ECA as well. The questions are very standard. Basically, is to ask you to do a valuation now by yourself for the final exam and write a valuation report. Right. So the purpose of this course really is to teach you how to value a company. So in the first lecture, we did the qualitative component. Then second lecture, we did overview of the quantitative component. Last lecture, which is lecture 3, we covered in detail DDM, discounted cash flow. Arguably, I would say that the DDM is seldom used in your valuation if you are doing your GBA or even your ECA, you know that people tend not to use it because it's too simplified. And so this lecture we're going in detail for the cash flow model and as well as the residual income and EVA. So these models are more important because they are models that you will likely be using in both your GBA and ECA, right? So in case you have any questions along the way, do not hesitate to ask them. Of course, if you have such a question, most likely your classmates also will have this question, and we can all learn from the questions. I want to highlight as well, even though in this module, you know that the final exam is more like a project that you have to do by yourself, your GPA is also like a project, we do have some so-called self-review questions at the end of the lecture. And so the self-review questions really relates more to those of you who are interested in do the CFA, because as you know, whatever we are covering in this module is also very closely with the CFA. So those questions are what you might find in your CFA as well. Even though you are not tested in this current module how to work out those questions, but it really help you understand how to use the various tools like the CFF, the FCFF, FCFE, how to even do the calculations, right? So, you know, even though you will not be tested on those questions, you will just be good practice to have a look at them. Right. Before we kickstart the lecture, do we have any questions that I have to pose? Any queries? Okay, no, very good. All right. Okay. All right. Okay. So let's do the FCFF. So in lecture 2, we already covered the FCFF. So now really the discussion is to first go through the various stages. Recall that we have the broad way we do it is there's no growth, then there's stable growth, and there's a two-stage growth model that we covered in your DDM. And so these three components will be also covered for your FCFF, FCFE, and residual income model. So we will cover these three key models for each of the valuation techniques. So you might find it a bit repetitive, but bear with me. I will try to highlight to you the subtle differences so that as you are doing your assessments, just be very careful on these subtle differences. Okay. All right, so for your free cash flow to firm, FCFF, just want to highlight that you are looking at a firm level. So whenever you look at firm level, we always have to consider the WACC, right, weighted average cost of capital. And in this case, we are looking at no growth, right? So no growth meaning that G is 0. So there's no growth here. And in a no growth situation, similar to your DDM, discounted cash flow, discounted dividend model, we use the present value of your perpetuity as a way to determine the firm value for your FCFF. Because instead of using your dividend to be discounted, we use the FCFF for the discounting. Right? I think in lecture 2, I also highlighted this important point that when we calculate firm value, the firm value is equals to the equity value plus your market value of the debt, right? So in this sense, if you want to calculate the equity value, we take the firm value minus the market value of debt. So this is an important concept. So the firm is made up of both the equity and the debt, and so the equity plus debt gives you the firm value. Important thing to take note is that we have used the market value of the debt, and the market value of that it can be given by the number of bonds outstanding multiplied by the market price of each bond. I have a question. Is the market price of each bond equals to the par value of the bond? No? Okay. No, that's right. So what is the difference between the market value of the bond and the par value of the bond? Yeah. Okay. And market value is, yeah, that's right. Market is what you pay now. What's the bond worth now? And par value is what you get at the end. Yeah, you're totally right. So just be very careful when you do your determination of your let's say market price or market value of debt. Just be very careful what you're using. Okay. Yeah, right. So please don't confuse between par value and market value. Value per share, we just take the equity value. Once you determine the equity value divided by number of share outstanding. Okay, do you have a question? Does firm value include adding the non-controlling interest and minusing using cash? Okay, so good question. So firm value, let me just think about it. NCI, non-controlling interest. So for everyone's no plus non-controlling minus cash. Okay, so does everyone know what is non-controlling interest? Everyone heard of it? Yes. Okay, yeah, I guess you have, since you know what's non-controlling interest. Okay, so non-controlling interest includes preferred share. Okay, not really preferred share. So basically, the firm might have some minority stakes in certain companies. Maybe is it 10%, 20% stake. So they are non-controlling, right? So they are not part of, they're not consolidated in the financial statement. So if it's a subsidiary meaning more than 50% owned, it will be consolidated in financial statement. So those will be consolidated, and so they're not part of the non-controlling interest or NCI, right? So for non-controlling interest, generally, what your classmate mentioned that your equity value is the value of the equity plus the wait, what's EV? Equity value. Sorry, I think EV is it enterprise value? I think enterprise value. Yeah. Okay. So you're talking, okay, enterprise value. Yeah. So enterprise value means the value of, almost like the value of the firm, right? It's value of firm is equal to equity value plus debt value, right? But enterprise value has a slight difference in terms of the formulation. So you must add back your non-controlling interest, which is generally not part of equity, right? Because equity is part of um, if the firm, if the subsidiary is part of the group, and then that's where it's part of the equity, right? But then for non-controlling interest, it's not part of it. But for enterprise value, you will have to add back and minus the cash. Yes, you're right. Okay, I have a question that is directed to me, say that is equity value equals to enterprise value minus uh, net debt? Correct. So there are multiple variations in terms of formulation. So now we're not really talking about it's not really about net debt, I would say. I would say use the market value of the debt instead. Yeah. So uh so if you use net debt, right? Net debt is your balance sheet figure, right? So it becomes a bit tricky. So there's many ways to determine your equity value. And the thing is, if you use net debt, you're using most likely your balance sheet figure, you net off various, whether interest, and you get your net debt, or the amount that is being repaid, you get a net debt. So instead of using net debt, the thing is you should use the market value of. Right. Any other questions? Sorry, I just noticed something. Actually, I think when you mentioned enterprise value, right? Are you referring to the firm value? Because so if you are referring to the firm value, yes, the adjustment for the non-controlling interest minus cash is quite of a typical way where we adjust for the firm value, simply because generally your non-controlling interest is not part of the equity value, which is why we add the non-controlling interest because that is still adds up to your firm value. So we add it back. And the reason why we remove cash is because cash is quite liquid, right? And it doesn't really add to your enterprise value or your firm value. That's why we minus cash. So those two are some additional adjustments that we do, for some, if you're an analyst, you want to kind of really determine the actual, let's say, firm value, you can do a bit of adjustments here and there as well. Okay. Okay, so no other questions. All right, so just now was more for no growth, right? So for stable growth situation, a stable growth situation, recall in the last lecture, similar to your DDM, we use the growing perpetuity because it's growing at stable rate of G. So it's just WACC minus G, which is your growing perpetuity formula. Just highlight, you want to highlight here, uh, please be careful to know what is your FCFF, whether is it FCFF at 1 or at year 0. If it's year 0, you need to multiply it by 1 plus G. So these formulas are a repeat of what we kind of mentioned in lecture 2. So these are important formulas. So the FCFF can be derived from the net income. It can be derived from the EBIT or EBITDA, right? Or it can be also derived from your cash flow, where your CFO, this is your operating cash flow from the cash flow statement. So this is your uh, important thing is your cash flow statement in your uh, FS, right? Financial statement. Okay. At this point in time, I think in lecture 2, I did mention that in the subsequent lecture, I'll cover or show you the proof of how you actually derive, let's say, this formula and this formula from your base formula of net income. So let's have a look at this, right? Okay, we know that the net income equals to your EBIT, which is earnings before interest and tax, minus your interest expense, minus your interest expense, and then you minus your tax, right? One minus tax rate. So this gives you your net income. Now, your once we know this formula, we can, let's say, just multiply your EBIT into the one minus tax. So just multiply it in, and then multiply this in here. So this is the whole thing. So you get EBIT times 1 minus tax minus interest expense times 1 minus tax, right? Once we do this, we shift the minus interest expense times 1 minus tax over to your link, as you can see here, and we get this EBIT times 1 minus tax rate. And then, once we have this, we add depreciation on both sides here, depreciation, depreciation. And by doing so, we have gotten this formula, which is what we see here, right? In the first formulation of FCFF, which means that this formulation of FCFF will be equals to this formulation here, as given here. And so we have proven how your net income variation of FCFF can be given by your EBIT formulation of FCFF. So again, this is just for explanation. You'll never be asked to prove this, right? I do see a question here from, what if I use my own this minus this? Okay, so generally, right? Okay, let me just go back to this formulation here. So this formulation using the operating cash flow statement, the reason why you might not get the same answer is because the cash flow statement, operating cash flow, generally have some adjustments that's being done in the cash flow statement, right? So without going to the detail, because I know most of you are not accounting students, because there's some the cash flow statement, there's two methods of presenting a cash flow statement, right? One is to start off with your net income and then add in all the details to eventually get your cash flow statement. Or there's another method where you just include all the so-called journal entries to give you your cash flow statement. Okay, so let's think that there are two methods to get a cash flow statement. So because of that, your cash flow from operations derived from your cash flow statement, sometimes by using this formulation here, you might not actually get the same answer as this one, or this one, right? So put it simply, if you are looking at a financial statement, try to use this three method here. This three method is generally will not give you any issues. In fact, they should be equal to each other, right? And this method is just a separate method that you can use. Yeah, so your answer might be different for this method because of the various FRS requirements, which might cause your cash flow statement differ from your method of calculating your FCFF. Uh, and so maybe the question is, how come I'm showing you this formula exists, right? So in case you are doing like last I mentioned your CFA sometimes if you do your CFA questions, you'll notice that they give you cash flow from operations, and in those short answer questions, um, it is such that they structure it such that by using your cash flow from operations from your cash flow statement, you can actually get the same answer as using your FCFF from your net income, right? They structure the P&L statement and your cash flow statement to be aligned to the extent, and so you can use both methods, right? But of course, in your let's say your GBA or your ECA, I'll recommend you to just stick with the first three method here. And just know that you can also derive your FCFF using your cash flow statement. Having derived the EBIT formula, let's try to derive the EBITDA formula, right? So the EBITDA formula, we know that EBIT equals to EBITDA minus depreciation. I know there's amortization as well. Here, amortization, but I just lump it as depreciation, right? So just imagine depreciation, this one is amortization and depreciation, right? So given this formulation, we can try to formulate the EBIT formula of FCFF. First, by multiplying 1 minus tax on both sides, as given here. Then we add depreciation on both sides, right? By doing so, right, we already have derived the EBIT formula of the FCFF. But on the right side here, let's try to make it a bit simplified. So I want to multiply EBIT multiply by 1 minus tax, and minus depreciation, I want to multiply it by 1 and multiply it by minus tax rate. So by doing so, I've gotten this thing here, and then I notice that depreciation and depreciation can cancel out, which is why we get depreciation times tax rate. And so our EBITDA formula is given by this. EBITDA 1 minus tax plus depreciation times tax rate. Okay. I'm just going to flip back to the previous slide, right? And let me just erase some of these scribbles. So one of the reasons why I did the proof for you is this thing, right? Previously, some of the students were wondering like, oh, see, the first formulation is depreciation. Second formula is depreciation. How come the third formulation using EBITDA becomes depreciation times tax rate? And then it becomes a bit confusing, right? Like, can you actually prove that why the first two formulations is depreciation plus depreciation and the third formulation is depreciation times tax rate? So the purpose of the two slides to prove to you is to explain to you why this is depreciation times tax rate here. Right? In case it's a bit too much, don't worry because you don't have to memorize this. You just need to. It's just my explanation to show you that why there's a depreciation times tax rate simply because we have cancelled the depreciations here. All right. Okay. So this is an important example. So let's look at this example here. ACME Limited had revenue of 120 million in 2011. The EBIT margin is 20%. Working capital as a percentage of sales is 30%. So you know that 30% of the sales is working capital. Revenues are expected to grow at a constant rate of 10% every year. So your this revenue here is going to grow by 10%. The debt has a market value of this. Okay, this is important, is a market value. The company has a target capital structure of 40% debt. The cost of debt before tax is 8%. The cost of equity is estimated to at 14%. The number of shares outstanding is 50 million. This number of shares are important number of shares. Calculate the value per share using the FCFF model. Tax rate is 20%, assuming capital investment will offset depreciation. This is very important. Okay, I'm just going to put 2 stars here. Anyone can explain what does this mean in simple terms? Capital investment will be offset by depreciation. Yeah, your capex, right? So your capex is your NCS in your formula. So they'll be exactly the same and you'll be cancel out each other. Yeah, right. So let's see how does it appear. Okay. So on that point about cancelling out means what? Okay, let's say I'm just going to zoom here just to explain a little. The NCS, this whole lump sum, this whole thing is going to cancel out with your depreciation. So if I'm using your EBIT formula here, this one, this is going to cancel out like this. Yeah, means it's gone. Yeah, right. So this is going to cancel out like that. Okay. Okay. Having understood this, okay, let's see what's happening here. Okay, so we have the revenue which is given in the question 120 million. We know that EBIT is 20% of revenue. So 20%, this is your EBIT for 2011. We know capital investment equal depreciation, which means this cancelling out that we have seen here. Right, it's more cancelling out. We know working capital is 30%. Sorry, this is a typo. This is 2011. Small typo here. In terms of revenue for next year, it will grow by 10% every year. So 1.1. Again, the EBIT is this, and then working capital is this, right? And the reason why we wanted to calculate the second year's working capital or the year 2012 is so that we can determine what is the change in working capital, change in or net working capital or working capital. So at this point, I want to highlight to you, I put 2 stars here is this, right? Even for your TNA, right? Some of you all make the mistake of not calculating change in net working capital. So please be very careful in your subsequent assessment. Always calculate change. I'm just going to highlight here change in net working capital. So you're not looking at working capital, you are looking at the change in net working capital. Everyone clear? Anyone needs me to repeat this thing about change? So far so good. Okay, so I like I mentioned, I think I noticed a handful of mistakes, this change in net working capital. So I just want to highlight this again because this will really affect your valuation. So please be very careful and use the change in net working capital. Right, having done that, we can now calculate our FCFF. So FCFF is your EBIT. So I'm using an EBIT formula. So I already calculate EBIT, which is this, right? This is your EBIT times 1 minus tax. And then since your depreciation and this whole thing cancel out, I just need to minus your change in net working capital, which is given by minus 3.6. So once I determine my FCFF, I can calculate my weighted average cost of capital because for we're valuing the firm, so we need to calculate a WACC. Um, just want to highlight to you that please consider the tax shielding effect of your cost of debt. And then since it's a situation of stable growth, the growth is stable, means that we're using the growing perpetuity formula. So this is your growth rate G, right? G, and we take the FCNF divided by this WACC minus G. This is your value of the firm. But what is the question asking you for? Let's look at it. Calculate the value per share using the FCFF model. So value per share means that you're looking at the firm value, right? Value per share. So we know the formulation that if we have the market value of debt, I can take the firm value minus the market value of debt, which is 800 million. This gives me my value of the equity. And then we divide it by the number of shares, which is 50 million shares. This is your answer. Okay, on this point, right, I want to highlight to you. I probably mentioned about this before in the past, but I'd like to raise the question, see whether any of you can remember, right? What do you recall, are there any other formulation of calculating your net working capital instead of your classical example of CA minus CL, which is a pure accounting method for calculating net working capital? Are there other formulations? Anyone knows whether are there any formulations? So you know that net working capital. Okay, let's see. Change in inventory plus this minus change in. All right, yeah, right. So net working capital is okay. So yes, okay, both of you are right. So both of the formulation is right. Now let me explain to you again this one in case this becomes relevant as you are doing your company valuation, right? Now, net working capital (NWC) equals to CA. Take all your total current asset minus total current liability (CL). Now, this formula here is a pure accounting concept of CA minus CL. Now, we are not in an accounting class, we are in a finance class. So the thing is, in your CA, right, the thing about cash is kind of relating more to cash management, really your working capital, right? How much cash you have is your cash management, how much debt you have taken. For example, if you take on some debt, you have more cash, right? So sometimes in finance, we don't care about the cash component, which is why we just look at change in inventory plus change in accounts receivable. Now, on the having said that, on the CL side, sometimes we do not consider short-term debt because short-term debt is mostly for on the capital structure of the firm. It's not really the working capital financing requirement. You're right. So we just focus on the change in accounts receivable. Right. So I hope you can see the difference. Now, then the question is, which formula should I use? Um, Generally for finance, right? Finance, we focus on the change in inventory, change in accounts receivable, minus the change in accounts payable. So we use this formulation more than the pure accounting method. And in fact, if you go and Google and search, right, you will see many other variations. Some people still want to add cashback. Some will not want to add. So there are many formulations, and there's actually in finance, there's no right or wrong. The concept is just depending on how you are going to use the formula, how you're valuing your firm, you can use variations of the formula. Of course, if you suddenly say you add long-term assets or non-current assets, then you're totally off. Yeah, you're right. So cash is non-operational, which is why we do not really consider it under the net working capital. But in a pure accounting sense, you will include cash. But let's say in your net working capital and you want to use the more finance kind of method or understanding, then you should not include cash. You're right. So it's more about the investing activities. Okay. So this is just a bit of more details about why do you not consider depreciation, but it's probably what you saw earlier. And if I can't understand why we cancel out this part here and here, then this kind of explanation, right? So first, in a high growth stage, your fixed asset turnover will be constant. So this is a condition, right? It means that what? The difference in gross, the amount of capital investment will be equal to the difference in gross fixed assets for the two consecutive period. Now, I have a question here. The difference in gross fixed asset, what does this represent? Like, what if you take the difference in the gross fixed asset for last year, for this year minus the gross fixed asset for last year, what the resultant value gives you what? What does it give you? So I take this year's gross fixed asset minus your last year's gross fixed asset. What does it give you? Net PPE, not really, because you're taking one gross minus the other gross, right? So what does it give you? Change in gross, you're right. Change in gross, okay, capex minus depreciation. That one not really, right? Capex. Capex minus depreciation. Okay, you are there. You are a bit there. Okay, so movement in let me see, movement in PPE. Okay, yeah, movement net investment. Okay, I think you are getting there. So capex minus depreciation, you are about there, but it's actually just what the change in your investment, fixed asset investment, right? Change in fixed asset investment, meaning what? How much do you invest in fixed asset, which is, I guess, what you're trying to say is the capex, right? Um, and then any depreciation, which is, you're right, minus depreciation. So any change in depreciation, okay, you can call it change in depreciation or any depreciation. Let's just put a depreciation here, right? So you're right. So change in fixed asset investment, so any additional fixed assets being purchased, and of course your depreciation, right? So there's actually a bit of a typo here. I'll remove this because this is not correct. Okay? Because it refers to change in fixed asset investment minus the depreciation. And so the thing is, we need to provide for, so there's this depreciation here, right? So basically we need to provide, okay, so I'm just going to feedback over here and just highlight to you how this, so let's say this is depreciation, right? This is depreciation minus the change in fixed asset, right? Okay, change in fixed asset. So this depreciation will cancel out this depreciation as what we see earlier, right? But in a high growth stage, we will have this additional change in fixed asset. So the amount of capital investment is how much you need to provide in addition to your depreciation charge, which means is this, your change in fixed asset. Okay? So in other words, let me repeat. The In a situation of a high growth stage, your fixed asset turnover is constant, means that amount of capital investment is your difference between your gross, which is important, gross fixed asset between the two periods. Now, your gross fixed asset is, yes, gross is before depreciation, right? So it's before depreciation. So it means that when you take two gross amount, is when you less them off, what the resultant value is basically your change in fixed asset investment amount, i.e., if you bought any fixed asset or you actually dispose any fixed asset, minus your depreciation of your fixed asset for that year, right? And so because of this, we know that this component here minus fixed asset cancel out with the plus depreciation in your cash flow, operating cash flow. And so what is left over is your change in fixed asset investment amount. And so whatever you need to be provided is only the capital investment, which is your change in fixed asset investment beyond what is the depreciation charge. So please take note, this red thing is wrong here. Huh? This is not very correct. Okay. In the normal growth stage, the company can grow without external financing. And so this is correct now. Right? Funds needed for capital investment will be provided by the depreciation amount. So because there is normal growth, so whatever capital investment would just be the depreciation amount. And so because of that, your NCS equals to depreciation, which is what we saw in the other question, and your depreciation equals to depreciation, and basically these cancel out with your operating cash flow. This one, your operating cash flow depreciation here. So this a little more for just in case you're practicing the self-review questions, just read very carefully what the question is trying to say, and then treat the information accordingly. All right. So those are single stage FCFF. Let's look at the two-stage FCFF, which is very similar to what we saw in a two-stage DDM, right? So we have two stage. First is a supernatural growth, GS, and then your low growth, right? GL. And so we have n number of years in your supernatural growth. And so this formulation, I generally do not really like to use this generic formula because it's easier to try to understand it um, through the process of discounting the various cash flow, right? So let's try to understand how it works. So we have an example here. So this example, we'll use it again for our FCFE as well. Okay, so let's look at this. Apex Manufacturing has a current sales of 50 million. Sales is expected to grow 14% for next 4 years. From the fifth year onwards, the growth is expected to be normal at 6%. Okay, so again, I like to draw this small little diagram here. So you start at 14, you drop to 6, and you drop to 6 only at the fifth year. So for 5 years, you will be at 14%. During the growth stage, capital investment is expected to grow at 20%. So this is your NCS, while depreciation is expected to grow at 25%. Okay. During the normal growth, depreciation will offset. Okay, so once it reached after the 5 years, right? Here, your depreciation will offset your capital investment. EBIT, the EBIT margin will remain at 24% for the whole period. Okay, so 24% of the sales, of course. Working capital will remain at 20% of the sales. Currently, equity is this and debt is this. Means what? Currently, there is 50% equity and 50% debt, right? Both are equal. So 50% equity, 50% debt, and we have 1 million shares outstanding. Cost of debt is 10%. Cost of debt during normal growth period will fall to 9%. And these are both after tax. So that means we need not consider tax rate because it's after tax cost of debt. Capital investment last year was 2 million. Depreciation was this. So they give you what's the year zero capital investment, year zero depreciation. They give you some risk-free rate, market risk premium, as well as the beta for your growth and normal. Right? Growth, of course, higher risk, higher beta. Tax rate 20%. During normal growth, your equity will account for 2/3 of capital and debt is 1/3. Right? So it makes sense. Normal growth will have more equity, less debt, right? Because you do not really grow so fast. So lesser debt. Okay, so quite a bit of information. Let's try to dissect this by first calculating all our various discount rates. So given that we have your beta, we can immediately use the CAPM model and calculate cost of equity, growth stage, which has a higher beta, and cost of equity at a normal stage with a lower beta. We are given that the proportion of debt to equity is 50% at a growth stage, and then it drops to 1/3 debt and 2/3 equity at a normal stage. We are given this already in the question, 10% for after tax cost of debt for your growth, and for normal after tax cost of debt for your normal. These are two, we have calculated this, and because of that, we can calculate the WACC here. Okay, so this is where it's important. Like chances are you'll be using something like this in your GBAA or ECA. So we start with the sales, right? And then we know that sales grow at 14% every year. So, in your project, you probably need to do some forecasting. So you forecast at 14%, let's say increments like this. Okay. But at year 5, because it drops to 6% growth only. EBIT margin is flat at 0.24%. Sorry, not percent, 0.24. We have 1 minus tax rate. So EBIT minus 1 minus tax. This tax rate is 20%. So basically, I have now derived in rate. In rate is this, right? So I color coded the rate means that the various components of our FCFF. Okay, in black they are just more like sub answers, right? But the red ones are the numbers that we're interested in. Okay. Depreciation in the question, if you flip back to the previous page, we know that it was given at 1.6, and then depreciation grow at 25% every year. So depreciation keep on increasing, but there is an offset on the depreciation and NCS at a normal growth, right? But when we are at exponential growth, our NCS keep on increasing at 20%. So we start off with 2, we keep on increasing 20%, 20%, 20%, 20% like this. Okay, so we have determined our depreciation, our NCS here. Now let's determine our change. Let me just highlight this. It must be a change, change in net working capital. So our net working capital is going to increase at it will not increase, but it will be 20% of our sales, right? So 20% of sales. So 20% of sales, 20% of sales here, 20% of sales. That's 20% of the sales amount. So our change becomes this figure minus this figure here. So this is your change, 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 change. So all these are in red. So all in red means that it's the figures that are important to calculate your FCFF. Any questions here? Before we go to the next slide, any questions? No? Okay. So if you yeah, okay, so we go to the next slide first, right? So now I have just put all the figures in red in one line like this, right? So all these are just repeated figures in red. So having all the figures there, I can now calculate your FCFF. We just use this formula here, plus this, plus minus your NCS, minus your change, right? We do the same for all this. We know our WACC is the same as high growth, and then it drops to a lower amount at a low normal growth. Then at high growth stage, we present value all the figures to year zero, present value it. So basically discounting it. And we calculate the terminal value for year 5 onwards, assuming a stable growth, right? Based on question, stable growth. So growth at 6%, stable, so it's a growing perpetuity. Of course, we know that this terminal value is as of year 4, right? It's as of year 4. So from here, we do need to discount it back for years to determine the present value of terminal value as given here. So I have a just, yeah, so why not year 5? So good. Why not year 5? I'm guessing we say why not discount it 5 years, right? So this is you just need to be very careful when you do a thing as well. Because remember that when calculating your terminal value, so terminal value here, right, is a year 5. But what's your formula? Your formula for growing perpetuity is always 1 year from today, right? Your cash flow 1, right? So when you calculate the terminal value here using your growing perpetuity, is as of year 4, and how many years do we have to discount it back? We have to, like I mentioned, hop how many times? 1 time, 2 times, 3 times, 4 times. So that's why we discount it by 4 years. Okay. So sometimes if you get a bit confused, do draw a timeline to help you understand which point of time are you at. Going back to step 1, these are all just discounting it, all the various cash flow back. So this for year 1, just discount once, 1, 2, 1, 2, 3 for the 12.07, and for year 4, 13.90 is 1, 2, 3, 4. So you discount it 4 times. Okay. So finally, we add up all the present values. These are all the present values, and this is your present value of terminal value. So this will give us the value of the firm. We know that the question was the value of the share. So the market value of that is 20 million. So we take this minus market value of that divided by number of shares. This gives us the value per share. Questions? No? Okay. So this template will be something that is good to use when you are doing a calculation, because you likely look at the financials, you do some forecasting, you do some assumptions, really encourage you to write down the assumptions that you're trying to use here. What's the sales growth assumptions, and then from there determine oops, sorry, determine the value of the firm. Yeah. So for this case, we do not add the cash. You're right. So like I think yeah, because there's no statement of cash as well in this question. And the thing is, so there's also multiple formulas on how we calculate our let's say value of the firm, right? So in this question, there's no cash, which is why we didn't mention it. But if you refer back to let's say your study guide, right, you'll notice that for study guide, um, they typically not use the formulation where they minus the cash, if I'm not wrong. Correct. If in case you notice a change in study guide, do let me know. But the last I checked, there was no mention about this formulation where we add back the cash, right? To get the equity value. However, yeah, so based on idea, there's also no. However, I know that there's this formulation where you actually add back the cash, right? Which is not uncommon because I've seen that before. So in a sense, finance, you notice it's a bit more flexible to the extent that if it makes sense for you and you're able to justify why you want to add back the cash, then it's fine, right? There's no right or wrong. Of course, there's some very wrong way to do it, but like the cash part, it is a bit of flexibility that you can use. Okay, so before we take a break, as we like to do two breaks. Before we do that, I want to highlight to you that in your GPA or your ECA, right? Whenever or okay, not even in those two assessment, but in just in general, right? When you value a company, the methodology of how you get your valuation at the end is more important than the value that you propose at the end, right? So what does it mean? It means that, let's say you want to do the plus the cash method, that's fine. But do state it in your description why you want to use method, why you add back the cash. Where you can explain the reasons, and then from there, then you determine the value, right? So at the end of the day, you will just get one value, right? Maybe like what you see here. At the end of the day, oh, you get 1.99. So in case you value the same company, let's say both, let's say three groups value SIA, and all of y'all get different numbers. 199, maybe I'm just making up numbers, 204, 206, something like that. The final answer is not as important as how you actually derive the figure. So all your substantiation, the various methods you have used, so all those are more important than your final figure. So do not worry about your final figure, right? It's really about how you should get there. Okay, so if your WACC less than G, chances are something is wrong. Okay, so I think in the last lecture, I did mention that I really encourage you to use the market intelligence platform, whether it's Refinitiv, S&P Capital IQ, or if you have access to Bloomberg. I know some of you are working, so you might have access to Bloomberg. You use Bloomberg as well. And chances are they will give you a rough estimate of your cost of capital, cost of equity, cost of debt, right? And so you can use those as benchmark to actually try to reverse engineer to get that answer, right? Because this kind of market intelligence platform generally are more sophisticated than what we are teaching, and chances are they are more accurate and correct. Okay. Uh, let's say yeah, okay, let's say you use the sustainable growth rate is a bit too high. Maybe you can write, okay, I calculate sustainable growth rate for you, maybe in the back of your mind, you compare with your Bloomberg Refinitiv if you think it's a bit too high. You can suggest a different method, maybe just use the average growth of a company which, let's say, you found is closer to your the growth rate given in Bloomberg, then use that, right? And then you say that based on whatever reason you try to come up with some reason, the growth rate calculated using your sustainable growth rate seems too high, and then therefore I would like to use the average growth of revenue or something like that, right? Average growth of revenue as my growth rate for the firm. Yeah. So yes, you can do that. So do not worry that you must, die use the sustainable growth rate, even though it looks totally off, right? So really a good benchmark is refer to a market intelligence tool. Use that as like almost a benchmark for you to work towards that number, right? Of course, in case you are using Yahoo Finance, I'll strongly discourage you to do that because chances are their method of calculating is maybe less sophisticated and they might be very far from the actual number, right? So if you use Yahoo Finance, there might be some negative points for you, right? In case it's not substantiated well. All right. So, let's take a quick break. Let's come back at maybe, let's say, 8:15, and then we'll continue with our second part of FCF. Right? How is everyone doing? Welcome back. Good. So, okay, so we're going to cover FCFE. For FCFE, we are going a bit faster, because it's just kind of a repeat, right? Just that now instead of our free cash flow to firm, we're just going to equity, meaning that we are going to use the cost of equity rather than our weighted average cost of capital. So, for no growth, same thing, will be a perpetuity. If it's a stable growth, we're going to use a growing perpetuity here, right? Again, repeat for FCFE, because we are only concerned with the equity holder, we are using cost of equity. So some formulation as well. This to show you the various formula for FCFE that we can use. So what we can do is we start off with our FCFF here, FCFF minus your interest times 1 minus tax rate plus net borrowings. So net borrowings is your change in your borrowings. So change in short-term borrowings minus plus change in long-term borrowings. Um, and then we substitute the various formulation of our FCFF here. Right? So in this sense, we substitute the version of the net income version, and we can actually cancel out the interest minus interest times 1 minus tax rate. And so we can get a more simplified version like this, plus our net borrowings. Similarly, we can substitute the EBIT and EBITDA version as well, as you can see here, EBIT and EBITDA version. Last but not least, I just want to highlight to you this one. The last formulation is might be actually kind of the more important formulation in the sense that even your TMA, you are required to use this debt ratio formulation here, right? This debt ratio formulation where the debt ratio is your target debt ratio given by your total debt divided by your total asset. And so we have one example in a subsequent slide to show you using the formulation of your debt ratio. Okay. Same for your FCFE, you have two steps. I will not repeat so much about this. We have an example here, which is again similar example as your FCFF, some slight tweaks. Okay, let's look at the question. Same Apex manufacturing, same thing. Current sales 50 million. Growth at 14%, drop to 6% in 5 years, exactly the same as what we saw earlier just before the break. Um, Capital investment grow at 20%, same thing. Depreciation grow at 25%, the same thing as well. Normal growth, there will be offsetting of depreciation with capital investment needs. Net profit margin 12% for the whole period. Working capital 20%. Okay, so this is important here. Ratio remains at 40%. So this gives you a hint that you need to use the DR formula, right? The debt ratio formula, formulation of your FCFE. Number of shares 1 million, same. The capital investment during the last 2 years was 2 million, same. Depreciation is given at 1.7 million. These are the same. We have our risk-free rate, market risk premium at 7%. The data at 1.4 and 1.1. So information more or less the same as what we saw earlier. So let's try to formulate our FCFE. So FCFE, we are just interested in the cost of equity. So we calculated the cost of equity using our CAPM model at growth and normal stage. The numbers are the same as the previous example. Now, let's use like I mentioned, because there's a debt ratio, we are going to use this formulation here. So sales growing at 14% as given, and then on the fifth year it grows at 6% only. Net income is 12% of sales. You just multiply 12%, 12%, 12%, 12%, 12%. We have gotten our NI, which is what we found here. Again, I highlighted them in red. So those are the key numbers that we want to use for FCF. Depreciation is going to increase at 25%, 25%, 25%, 25%, and there's an offsetting at a normal growth stage. CapEx, 20%, 20% is the same thing as the last example, 20%. Now, the important thing is that we need to do the adjustment for debt ratio as given by this chunk here. So we take 1 minus debt ratio, which is given the question at 40%, times NCS minus depreciation. So NCS is given here, depreciation is here, and so we calculate our second part of the formula. Okay. For net working capital, the question is given at 20% of sales, 20%, 20%. Again, we need to look at the change in net working capital. So we take the year 1 minus year 0, year 2 minus year 1. And then what's important is that our third part of the formula for FCFE is you need to adjust it by the debt ratio or 1 minus that debt ratio. So we do the same thing, 1 minus that ratio times your change in net working capital, and these are in red, meaning these are the important figures that we want to find. We translate all the red figures here for simplicity, which is the key components here, 1, 2, and 3. And then we calculate the FCFE here, right? So NI basically minus this component minus this component. We get this. So given the free cash flow, we discount it back to year 0. Discount by 1 year, discount by 2 years, discount by 3 years, discount by 4 years. We calculate the terminal value using the growing perpetuity, and then we remember to discount it 4 times because you hit back 4 times to year 0, present value of terminal value. Okay, so I want to clarify, what do you mean mid-year convention? Do you think can clarify what is a mid-year convention? Discount 0.5 per year. So that means you are saying you discount it instead of yearly, every 6 months, is it? So you do my 6 months discounting. Are you trying to say that? No, as in our period will be 0.5 instead of 1. Okay, why will you do 0.5? I'm just curious, like, what is the reasoning behind using 0.5? In case it's easier, you can unmute yourself, or you can type as well as mine. So,
Yeah, Prof. Hi.
okay.
So basically, you discount 1, right? That's the assumption that you collect all your cash flow at the end of the year. So
Yeah.
0.5 will be like a better proxy.
Let me just think. I think you can do, yeah, you can say it's a better proxy. Okay, so what I'm thinking now is if you go along the argument of dividends usually being declared twice a year, right? So it's like every 6 months. Made on that basis, yeah, okay, can discount it 0.5. That'll be a better proxy. But for your free cash flow, I guess you can do 0.5. It's just that, so I'm just thinking out loud, right? In case any of you have other opinions, feel free to interject. But just thinking out loud, is there any, besides being a better proxy, does it actually help you get a better valuation, like significantly better valuation of your firm? That's what I'm thinking. What do you think?
Right, I think mostly the reason why I do it is just cause it's a little bit more accurate, if I'm not wrong, because uh on a day-to-day basis, the company will generate cash flow like every day, right? So
Yeah,
if we use one for year one, technically that means that you only get your cash flow at the end of the year, which is
yeah,
quite cyclical.
yeah, you're right. Um, and I guess you can get the half year's financials as well, right? So every
Yeah,
6 months you get
correct,
the
correct.
financials, and then you can use the half year's financials, for of course the baseline analysis, and then forecast every 6 months after that.
Mm,
I think based on that argument, you can actually do that. And then that's how you can justify it. There is, like I said, there's no right or wrong. You can do it. Um, for me, what I'm thinking is, does the extra effort warrant? So does the improved valuation warrant extra effort? For me, that's the part that I'm just wondering, because I'm not sure. But if you feel that by doing the 6 months, you really get a closer valuation, then I think it's worth it. So yeah, you can do
mm.
that.
Okay, got it, got it. Okay, thank you, Prof.
Yeah, most welcome. Cyclical, yeah, cyclical. Mm, I'm thinking about your comment. You want to count for cyclical periods, but if you're just discounting at 0.5, how does it account for the cyclical periods? Because you're still going to discount your, unless you're saying, right, you are going to omit, so that means you are doing the first half financials for the 5 years, right? So you only take the first half because you feel that first half is the most representative of the firm. So by doing so, that means you omit the second half, and maybe for your whatever reason you say the second half is a bit abnormal in terms of the demand. Let's say it's the retail company, abnormal demand. So you always omit the second half. So you only take a first half. Then in the argument, if you just discount the first half, you can argue that okay, you will omit any cyclical abnormalities. But if you're just doing every 6 months, your cyclicality is also included in your valuation rate. In fact, then taking the full year, I'm just taking out, in fact, taking a full year might even be better representation of diluting any cyclical cyclicality within the year, right? Let's say you have December being the highest sales, right? So let's say if you take full year, your full year, everything will be aggregated, right? And then you just get one figure for the year. Now, if you are going to take 6 months, 6 months, your first 6 months might be very low in terms of sales. Second 6 months might be high in terms of sales. Then by doing your 0.5, maybe you're going to incorporate more cyclical effects into your projection. Does that make sense?
Yeah, it does, it does.
Okay, good. Yeah, great question. Thanks for asking that. Okay, this one is a repeat. Let's not talk about this. You add up the values, you get the value of equity divided by number of shares. Okay, so you get value per share. three-stage. We're not going to cover this because it's not part of the syllabus, even though it's part of the CFA, but let's not talk too much about this. Okay. So in terms of residual income, okay, so we are done with our cash flow, right? Free cash flow kind of model. So recall that for free cash flow, we talked about just the free cash flow to firm, free cash flow to equity. Now, the residual income, this is in a sense we had an introduction in lecture 2, so something that's not new. But let's just do a small recap on residual income, right? So what's residual income? So residual income, um, we know first of all, before we go into what's residual income, we know that the income statement reflects the earnings the owner, right? The owners. Now, our net income reflects things like interest expense, which is relating to the cost of debt, right? Interest expense is part of your net income, as in it's being less off from your net income. However, it does not take into account your cost of equity capital, right? There's no like touch for your cost of equity, which is why there is maybe a disjoint, and therefore people are interested in this concept of residual income, where we are going to consider the cost of equity capital in addition to just the cost of debt, which is reflected in your interest expense. And so, because we're going to consider the cost of equity, the formulation of your residual income is very similar to your free cash flow to equity holders. And therefore, in any discounting of this residual income, we're going to use the cost of equity discounted. So some other names for residual income is economic profits or normal income. Okay, so this is not new. We have seen this equation for residual income. There are two equation, very similar. Just one is per share, one is no per share. So if you just take net income minus your equity charge. So what's equity charge? Equity charge is basically your cost of equity times the amount of equity you have, right? So cost of equity times book value of equity. You'll notice that why is there t minus 1 and 1? You have an example. Once you look at this example, you straight away understand why is this t minus 1, why is it 1, right? Once you see the example, you straight away understand. But just put that a bit of a mind first. But know that there's a difference in terms of the timing of the net income and the timing of the equity charge that you need to consider. Okay. Okay, so there's this formulation here. Alternatively, you can multiply this net income times this, and then net income times cost of equity. Is it? No. No, sorry, not multiply. Sorry, wrong. Uh, Alternatively, you can use your look at your ROE. So ROE is basically your return on equity. So whatever that your equity holder is returning to you, you minus the cost that's involved, right? And so this amount multiplied by how much equity you have will basically give you what is the residual, what's being what is remaining, right? So this second formulation is just a different way of thinking about it, right? Residual income is what's being remaining in terms of income. So take your return on equity, which is your income amount, minus the expenses, which is your cost involved, and this is what's remaining, right? But then you must multiply by the number of equity, which is the book value of equity, and therefore you get your residual income. So it's just a second different way of thinking about residual income. Okay, I see a question here. Okay, book value is historical, while market value represents the replacement cost minus the. Okay, so for this residual income, right, there's a reason why we use book value. Okay, this is very specific residual income, and we'll see this in. I think there's a slide about it in just a bit. So, for this one, it's a bit peculiar. You need to use the residual. You need to use the book value of equity. Okay. Okay. So we'll look at it in just a bit. But I like your comment there, right? So for this case, you need to use the book value. Okay, so residual income per share is the same, just that you use the EPS, earnings per share, which is like net income divided by number of shares, so earnings per share. Okay, book value equity, just to highlight, is your payout capital plus retained earnings. Okay, okay, so residual income model, right? In a sense, is actually not really a cash flow model, right? But then remember in lecture two, we kind of prove that it can be derived from your it can be derived from your DDM, which is a cash flow related model. So there are some similarities, but at the same time they are different as well, right? So your this residual income model, right, starts off with your book value of equity, right? There is a book value of equity, and then you add on any additional income that you receive, which is called a residual income. So you start with book value of equity, then you have a summation of all your RIs. So two parts here. So immediately you can already see a difference, right? Because your base is your book value of equity. And so maybe to your question, right, I hope you can already see that because your base of this model is your book value of equity, your residual income calculation here must use your value of equity as well, which is here. Because let's say you cannot be using book value here and then suddenly use market value here. It doesn't make sense. So the model itself uses book value. And actually that's one of the strong points of the residual income model, to the extent that the values you use for residual income model are found in your financial statement. So they're easy to use, right? Sometimes market value can be a bit difficult to derive. And this is more relating to private firms, right? So yes, your assessment or maybe the firms you are going to value are all public firms, or at least you are required to value public firms, where you can have the share price, you have everything, right? But remember, not all valuations for public company, right? You can be asked to value a private company, and so maybe the residual income model will be a better model if you are tasked to value a private company, because you just focus on the book values, which is found in your financial statement. Okay, so for residual income, there are multiple stages. You can do the same thing, single stage, double stage. So residual income can be forecast only for certain periods, but beyond which you will look at the terminal value. So your terminal value of your residual income, the same thing. We can do zero residual income, so zero growth, or it can be a declining or continue at the same level, right? So this is the same in the sense of your G is more than zero, meaning there's some growth. So if you're growing perpetuity, it can be declining, so your G keep on dropping, or it can be residual income is zero at terminal value, this equivalent. So that means there is no growth at all. So let's look at this residual income model here and a stable growth. So stable growth, will use the growing perpetuity. So notice that it's very similar to what we have seen, just that you have a G here because we are treating it as a growing perpetuity. ROE remains constant over time, book value grows at a constant rate of G. So at this point, I want to highlight again, your RI calculation, residual income, right, is this component here, is RI, right? This is your book value based on your balance sheet. And this entire model is called your RI model, right? So your RI model basically consists of two parts, your book value, which is your balance sheet, and then your calculation or your summation of RI. Your two-stage, this again is this is a generic formula, but the idea of it is the same as what we have seen in your FCFE, FCFF, where you have the supernatural, GS and GL, and you just calculate the various components, right? You calculate your GS here, you calculate your GL, and then you have the growing perpetuity at the end. So exactly the same. I want to highlight to you that your residual income model uses your cost of equity. So the point here is they are actually derived from the same underlying theoretical model, and we have actually shown this in our lecture 2, where we compare it with our DDM, if I'm not wrong, right? So theoretically, they should be similar in terms of the estimated value. The small difference is that your DDN and your FCFE, which is both relating to equity, forecasts future cash flow. Now, your residual income is different, right? You start off with a base value in your balance sheet, and then you forecast the residual component, which generally is a smaller component. Unlike for this case, is your terminal value, which is usually the largest component of your valuation. So some cases where companies are not paying dividend or have a unpredictable dividend patterns, maybe your free cash flow is negative, so you can't really use the free cash flow model as well. If you have some uncertainty in terms of your terminal value, recall that for your FCFE, the large component of the FCFE comes from your PV, right? So if you have large uncertainty in terms of the future, maybe your residual income model is better. Uh, Similarly, large terminal value is contributed for your DDM model as well. And last but not least, we have quite extensively on this clean surplus relationship. And so this is one of the conditions in order to use the residual income model. Unfortunately, in real life, this clean surplus relationship doesn't really hold, especially for a public company. So in case you forget what is this, encourage you to look at lecture 2 because we did go through quite a bit of details on this, right? So we need the clean surplus relationship to hold. So some additional comment, trend is that terminal value does not make up a large proportion, which we mentioned already. Accounting data available, so like a private company like what I mentioned earlier. Firm that do not pay dividends, we can still use it. If cash flow is unpredictable, we can still use it. We can focus on economic profits. Economic profits, remember, includes explicit and implicit costs. In terms of weaknesses, accounting data, I think like what you mentioned earlier, the comment is very good, is that accounting data might not be, it's very historical, right? Might not be the best data that to use it. Clean surplus must hold. Sometimes book value can be unpredictable. Book value and return of equity can be quite unpredictable as well. Okay, so I'd like to go through this example because sometimes it's a bit difficult to understand how to use the residual income model. So let's look at this example here. Suppose you have these bulk properties, expect a EPS of 2, 2.5, and 4 for the next 3 years. It's going to pay dividends at 1, 1.25, and 12.25 for the next 3 years. The last dividends is anticipated to be liquidating dividends, and analysts expect that bulk will cease operation after year 3, which is why the last dividend is so big, right? It's liquidating. But current book value is 6 per share, $6 per share, requires a return on equity of 10%. Calculate the share per share book value and residual income for the next 3 years. Estimate the cost of the thing using the residual income model. Confirm your valuation using your discounted dividend approach as well to compare, see whether they are the same, right? Okay, so let's understand this because this one is totally different from your FCFE and SCFF. So, because we are starting off with book value, right? So we need to determine the various book value. Okay, so we know that the question says in year one, the beginning book value is $6. There is an EPS, which is earnings of $2. And then we're going to pay a dividend of $1. So I'm just going to highlight all the stuff here. $2, $6, and $1 here. All right. So it means what? We are going to use the clean surplus relationship as mentioned in lecture 2, which is given here, to determine what's the ending book value of our share. Our ending book value gives us a beginning plus the EPS minus the dividends. And this gives us $7 per share. Yeah, sorry, not $7 per share. $7 of book value per share. Okay. So I will need to determine the beginning, so the ending book value for year one is the beginning book value for year two, right? And in year two, we're going to do the same thing. There's going to be some earnings, there's going to be some dividends paid, and then I can determine the ending book value for year two, which goes with the beginning book value of year three, right? I hope you can see the flow already. And at the end of the day, there's going to be zero book value because it's a liquidating, the company is going to be liquidated in year three. Now, let's look at equity charge. So equity charge per share, what's equity charge? Equity charge is book value in year T minus 1. Okay, this is where I mentioned, right? Why is there T minus 1? Why is there T? How come there's some like lag in terms of the values? We can see very clearly in this example here. So we need the book value at T minus 1 times the cost of equity. So cost of equity is given in the question at 10%. So we need to look at the beginning book value. So beginning book value, which is T minus 1, right? So these are the values we're interested in. So these are your T minus 1 given here. So now you know why it's T minus 1, because you're looking at beginning book value. So it's book value of equity in T minus 1, right? So we get our equity charge per share. After doing so, we now can calculate the residual income per share. And the formula is to use the EPS at T, okay? EPS at T. So EPS at T. So this is the EPS in year one, which is right at T, minus equity charge of T minus 1. So this is equity charge in T minus 1 because we are using the book value of equity at T minus 1 here, right? So can you see that there's a slight lag, but the lag makes sense when you put it in such a question. And so because of that, your residual income is 2, which is your earnings per share at T minus your equity charge at T minus 1 here, gives you this. So this is your residual income. You do the same, this is your residual income, this is your residual income. Remember, your residual income consists of two components, right? Your book value per share, which is 6 at here, $6. And then you add in all your residual income, right? Of course, discount your residual income because it's a summation of this your discounted residual income. So you discount it back to year 0, meaning this one must discount one year back as well. There's a year 0 here which is not shown. So discount 1 year, 2 years, 3 years. And this is your residual income value. Okay. Any questions for this residual income? Because this is quite different, I encourage you to try out the examples at the end of this lecture because it is a slight tweak in terms of how you usually do the calculation. Any questions on this? Any confusion? Where is the 1.1? 1.1 or 1.1 is a discount rate. The discount rate is 10%, so it's 10% plus 1. Okay. Yeah, so I encourage you to try out the residual income model because it's really quite different from your SCFE and SCFF. Right? Give it a go um, to ensure that you are able to determine your residual income. Okay? To show that it's actually similar to your DDM, we actually just focus on your DDM here, this one, your dividends, right? So by using this the dividends, we determine this using DDM, and we found that hey, you know what? Actually, it's exactly the same. Our calculations are exactly the same. Okay. All right, that's all for residual income. Uh, let's try to tackle this economic value added, right? So residual income, right? We mentioned that it's very similar to your FCFE, right, for the equity. Now, economic value added is a variation of the residual income, which is very similar to your FCFF because at economic value added level, we're actually considering the with at cost of capital, WACC. Now, for your economic value added, EVA is given by your NOPAT minus your capital, total capital times WACC. Okay, so what is NOPAT? So NOPAT is your net profit, no, net operating profit after tax, right? Which is given by EBIT times 1 minus T. And, and let's just see this, NOPAT minus total capital times WACC. I'm just going to flip back to your residual income. What's residual income? What's the formula for residual income? It is actually, can you see this? Net income times this minus book value of equity times cost of equity. Can you see it's exactly almost the same? It's just there are slight tweaks, right? Instead for your EVA, instead of net income, you use net operating profit after tax. Instead of cost of equity and value of equity, we use cost of capital and our total capital, right? Let me just flip back to EVA again. Can you see? We use total capital and with the average cost of capital. Total capital is equity plus liabilities. The question now is, okay, so what's the difference between NOPAT and net income? That's a that's hopefully that's your question because we'll look into that in just a bit. Okay, so EVA, let's kind of understand about EVA. EVA measure the surplus value created for the investments. Uh, okay, yeah, you're right. So no pet, there's some things about tax. You're right. Okay, what else? Let's look before we go there. Let's look and see return on capital (ROC) defines the true cash flow to capital earned on the investment. So cost of capital is your weighted average cost of capital, right? So your EVA can be given by return on capital minus cost. So this is very similar to your residual income, right? Residual income is ROE minus uh, cost of equity times your book value of equity, right? But in this sense, we use the return on capital minus the cost of capital times your capital employed. After tax net income, or you can use after tax net income minus the cost of capital times capital employed. And this component here is basically called your capital charge. And this is your NOPAT. Okay, so let's not ask the question, right? What is notepad, right? So your notepad, like I say, there's a lot of kind of adjustments you can do to get your notepad, right? One of them can be the text. What you mentioned about text, level and unlevel text, which um, there's this comment here. But what does notepad means? Notepad is the net operating income is adjusted to reflect the true cash. So the whole idea is to adjust it to reflect the true cash income streams rather than just the accounting streams. Because now we're in the more finance concept, right? So NOPAT is very much more finance related, and you do adjustments. So the adjustments could include, more of the interest expense, adjust for interest expense, deferred tax, minority provisions, amortization, and intangibles, and capitalization uh, of R&D. Okay, so this concept of NOPAT, right, changes with the company. So different companies have different variation of NOPAT on how they actually adjust the incomes to reflect more closely the business, right? So in the case where you're trying to adjust and get your notepad, kindly provide, the justifications of why, let's say, you want to capitalize R&D, or why you want to amortize intangibles. So try to justify it. At the same time, right, certain industries have certain, I would say, SOPs, like standard operating procedures for calculating notepad. So there are some standard kind of ways to do it for certain industries. So in case you're in the industry, just simply do a Google search, right? They will tell you it's very easy, or ask ChatGPT, they'll give you what are the standard adjustments that's being done for the notepad for certain industries that are working on. Employed on the front is everything that is required to run the business, right? All the capital required to run a business. This includes your debts, definitely all your debts, deferred taxes, minority interest, preferred equity, common equity, accumulate, accumulated amortization. So all your debt and equity related, including your deferred taxes as well. Okay, this is your capital employed. So any capital that's being used to run the business. On this comment here, there's a small comment here about these operating leases. So those of you all who are in accounting modules or accounting major, you know that operating leases in the Singapore FRS, particularly, that is no longer allowed. So you no longer can categorize operating leases. So if you do notice these, chances are there are non-Singaporean firm where you will see operating leases due in your balance sheet, right? Generally, in the Singapore FRS, operating leases are now categorized as rights of use, which is reflected as a asset, and then on the credit side, it's a lease liability, right? And this is for the lessee. Oops, on the lessee, right? So leases can be quite advanced in the sense that you need to be, yeah, IFRS 16. Um, it can be quite intricate because you need to look at two components. Are you the lessor, meaning the one that is being leasing out your equipment, or you're the lessee, which is the one that is receiving the lease, right? And whether you're lessee or lessor, the accounting is different. So I will not, even in your valuation, whether is it, your valuation assessments, right? You will not be required to, do all these very complex conversion of lessor, not really conversion, but understanding of the intricacies of lessee, lessor, and how these are being categorized in FRS. So don't worry about that, right? But what I'm trying to say here is that the conversion of these operating leases to debt no longer is required, no longer required because the FRS has required the disclosure of operating leases in terms of the rights of use, which is the asset, and lease liability for lessee. Still got operating lease and finance. Uh, So yes and no. Yes, there's still operating lease and finance lease, but your operating lease will now be, if you look at your balance sheet, is no longer operating lease expense in your P&L. Is now shown as a rights of use asset and a lease liability. The operating leases, you might see some lease receivables if you are a lessor, right? If you're a lessor, you have lease receivables, uh, and you will have some lease receivables, which is your debit, and then you will have a credit directly from your lease asset, which is your PDE. Okay. So you will not see operating lease expenses. This line item expenses will be no longer in uh your financial statement for Singapore companies. So in this sense, long story short, you do not need to do the conversion to debt now because it's already done for you. Okay, so good question. If your comms, right, uh, is a non-Singapore, chances are you might still see operating leases, especially US comparables. Um, I would say if you can do it, that would be very good, but it is not easy to the extent that normally, right, in the corporate world, because at the end of the day, it's uh, most of us are going to corporate, right? Maybe some of you all might do academia, but most of us are going to corporate. So in the corporate, right, this is done in a model. You use capital IQ. Okay, if capital IQ can do a conversion for you, then do it capital IQ and just put a comment there that you use capital IQ to do it. Because in the corporate world, no one does the manual conversion of operating leases to debt. So there is a little point I would say to teach you how to do it because you need to do the discounted cash flow and all those things. Because nowadays you just put in a corporate world, you just put in a model and then you just mention how much operating leases there are and the model calculates for you. And so if capital IQ can do it, then use capital IQ calculation. You need not show the working of how you actually uh, discount all the cash flows to get it. Yeah. So unless you are accounting major, maybe if you're accounting major, your accounting professor would still want you to do the manual method because you need to know the bases and all those things, right? So if you're accounting major, you likely would still have to learn how to do this manually. Okay. Uh, let's see. Last point, book value, use book value. So market value reflects only not only capital invested in asset, but also the expected future potential growth. Okay, so on this point, right, I want to bring back to one of the questions that's asked by your friends. Why we use book value for the RI, right? Residual income. Why we use book value? In the same sense, because EVA is very similar to RI. And the whole idea is that if you use we use market value, we include expected potential growth. And this means what? We are actually double counting the growth of the company in a sense by using both the market value and the EVA concept or the market value and the RI concept, right? Which is why we just use the book value here or EVA and RI. One more thing, just want to, before we move on to the last part on WACC, I just want to highlight something to you also. Normally, right, see if you're talking about the adjustments of operating leases, normally we do not in a corporate. Okay, so there is a very big distinction between how academia would suggest you to do certain adjustments versus what is being done in the corporate. So let me try to explain to you. So if you look at academia journals, right, a lot of them will say, oh, you need to capitalize R&D, right? So you have to capitalize because it is a form of asset to you. It can be intellectual property, whatever, right? So there's a lot of good reasoning in academic journals, and they are right, right? There are good justification to capitalize R&D. At the same time, also converting operating leases to debt. That makes sense. But remember, if you go to a corporate world, right, and if you look at what adjustments they do, typically they do not do this because you are being too overly optimistic that your R&D would give you some in the future. Unless some industry might do it when they determine that the chances of success is above 70-80%. That's where it gets a bit complicated because you need to consider probability of success, right? But in most cases, we do not capitalize R&D because it becomes too overly optimistic. Yeah, there are six rules uh uh on capitalizing R&D. Yeah, right. So in accounting, there are six rules. But then remember, this is not really an accounting really. It's more of like just adjustments for finance, right? So even for adjustments for finance, right, generally we do not do adjustments that will benefit the company. So that's the rule. So we have a baseline in terms of the financial statement. We do not adjust it to improve the financial standing of the company. We generally do adjustments that would deprove or not deprove, to pull down the standing of the company. So for example, when we convert operating leases to debt, typically this would cause the company to be worse off because their debt ratio increase, right? So most analysts are a bit more conservative, and so you tend to do things that will make the company's standing looks worse or deteriorate the company's standing, like converting operating leases rather than capitalizing expenses, because that is becomes very aggressive and your shareholders might disagree with what you're saying and you might face some pushbacks. Yeah, but then the sell side, so let's say you are so aggressive with your sell side and you're so aggressive, right? If, okay, for whatever reason, if your valuation, you of course probably quite sophisticated, there are a lot of reasons, but for whatever reason, if you are so aggressive and the expectation meets your valuation call, okay, then very good. You are like a analyst. But let's say if you are so aggressive, but the market do not agree with your valuation and the actual valuation is a lot different from your aggressive positive valuation that you have done by capitalizing a lot of things, then a bit you're not your reputation will be there, right? People will be saying you're too aggressive, you're not reflecting the actual market, blah blah blah, all those. So generally, analysts are a bit more conservative in that aspect. Last but not least, let's just consider the WACC. So this one is using market value, right? So this one, WACC always market value. There's no debate on it. So what you notice here is quite interesting. Your EVA, you're using a mixture of market value, book and book value in your assessment. So just be very cognizant on what is market value, what is book value, because it's important. Not everything market value. Okay, let's just go through. Should we? Okay, you know what? Let's take a break because I know it's already 9:10. Let's take another 7 minutes break before we finish off the last part of today's lecture. Okay. If you do have any questions, put the chat. Let's come back at 9:17. All right. Welcome back. Last part of the lecture. So, paying debt, I know it's quite a bit as well. Okay. So let's just look at the two last example of EVA. Okay. So we are given this company has a EBIT of 8 million, total capital of 26, with debt of 12. Cost of debt is 9. This is pre-tax cost of debt. Cost of equity is 15. Calculate the EVA, assuming tax rate is 70%. So we know NOPAT is EBIT times 1 minus tax. So we calculate what's the NOPAT. We calculate what is the WACC. No difference in the WACC in the sense that use the WACC, make sure that we consider the tax rate for your debt component. We got WACC, we can calculate our EVA, we take our NOPAT minus the WACC times total capital, which is given 26. Right? So the calculation wise, not super complicated, just need to be very careful on what we choose. Another example here, this company ABC Corp has a net operating profit after tax of 100 million. The book value of debt is 150. The book value of equity is 250. The cost of debt is 10%. Cost of equity is 14%. Stock is selling at 52. There are 10 million shares outstanding. So the WACC, so we know what do we know? We know both the book value of debt and book value of equity. See. So we are using both the book value for the WACC values. Not the best, but this is a question, so there's no market value given, so no choice. Tax rate 20%, so we take the pre-tax. Okay. You know what? I'm actually noticed something. Now I'm looking at the question, right? Maybe the answer that's given here might not be correct. What do you notice? Do you notice we're given the market value? See, market value of that is this, right? And we're given the stock selling for this price at and this amount of share outstanding. In this case, we can actually calculate the market values, right? Of the equity and market value of that. And we should use the market value for our WACC. Everyone noticed it? So I think this answer actually might not be correct. It should be amended. In any case, let's say we use market value, we get a WACC, which is obviously not this answer here because some use book value. And then we take the same idea of the NOPAT minus the WACC times the total book value of our capital, which is 150 plus 250. So this is book value is okay. So this book value used for this is okay. But then this one actually shouldn't use book value. We should be using our market value as given here. In any case, I will do the amendment and upload the new slides for lecture 4 because this one looks a bit wrong. But in any case, we are asked next to determine our MVA, which is market value added. So market value added, we have our market value of the firm is given by market value of debt plus book value, market value of equity, which is given as this, right? So uh, 670 million. So our market value added is basically 670 minus our total capital, which is 400 given by this and this. So this gives us how much value from the market is being added to the firm, right? So basically, we calculate the firm market value minus what is the book value, and this is how much market value added is given to the firm, MVA. There are just some advantages for EVA. I won't really go through, you can just look at it. It's just some comments about EVA, how it's close to the MPP, MPV, etc. So it's not, I wouldn't really go through. Okay. Um, okay. Actually, that's all we have for the content for lecture 4. Now, any questions for lecture 4 so far? No, for now. Okay. Do we have any questions regarding our GBA or more generally relating to the how we value a firm? Do you have any like just general questions as you are looking at the company and as you know, if you look through your ECA, it's likely to be also value a firm as per previous years. So you know the group one is so-called first trial of doing it as a group, so it's easier, but it's important to do the GBA very well because chances are you will have some model style that you have already done your GBA to do it for your ECA, right? Because chances are they're almost the same. So really try to focus on doing your GBA very well because it really will help you for your finals as well. So any questions regarding your GBA? Clarifications that you need to ask? So for the benefit of those who might be thinking of this question, some of you have asked whether the comparables have to be from SGX and in Singapore. The answer is no. It can be listed in other stock exchanges, need not be from SGX. It can be a foreign firm as well. Yes, you can do a sum of parts valuation. So presumably you have learned this in your other modules, right? So if you have learned this, you can, yeah. So so the thing about so I'd like to just comment, right? The thing about valuation is that there's just a lot of methods to valuation. Um, we try to teach you the more common ones. Some parts is also another way of valuation as well. And you can use that as well. Of course, in addition to use the sum of parts, also try to use some tools that's been taught in this class as well. Because you know, part of the assessment is to test what you have learned here as well. So of course, we do not restrict you to only use what you have learned in this class, but you can use other things as well. Yeah, so the part that I say not from SGX is the comparables. Like when they ask you to compare a firm. So a typical example would be, let's say you choose to value SIA, right? You know SIA is the only uh, airline in Singapore, right? The only other comparable, or not only other, but like other comparables would be like Malaysian airline, which is not in the SGX. So for that part of question, we can use different but as much as possible, your valuation in terms of um, doing your discounted cash flow and all those are supposed to be accompanied from SGX. Relative valuation, is this? Yeah, so for relative valuation, we'll cover that in the last lecture. You can use it as well if you already have some knowledge of relative valuation. Um, Question. Okay, so I guess we can, what the remaining amount of time, actually I'd like to go through the Nike case. Have anyone actually looked through this? Yeah, I see a question. If I use table, can I skip the workings for, like, for example, the top says grow year on year, but no need to show workings. Yeah, you can skip the workings. Um, no, you can skip the workings. You can skip the workings. Yeah. But okay, in case, right, let's say you don't have to show working for everything. Let's say you can show workings for the more complex one. For example, let's say revenue growth year on year 20% you have to show, but maybe let's say you want to show the 1 minus DR, let's say FCFE, right? 1 minus DR times NSC minus plus depreciation minus depreciation. Yeah. So that one is a bit more complex. Maybe you want to show that. Yeah, this you're right. So just keep the more common sense one. Not really very messy. I agree. Yeah, don't need to show. Or let's say there's a few ways to do it. You can even just show, let's say, let me just flip over. You see, you can, let's just say you just show like the first two and the rest you don't show. Something like that. You can do that. So, or just show one and the rest you don't show. So really up to you on how you want to do it. Questions. Have anyone went through the Nike case? No? Okay. Okay. One no. Anyone yes? No. Okay. Big hit, I would say the Nike case is extremely important. Okay, as even for your GBA and your ECA, because both are quite similar, as we have mentioned a couple of times. So please go through a Nike case. And since we do have time, I actually want to take the opportunity to go through, even though it might not be in a lot of detail. I would encourage you to go through it again. Okay, so let's look at Nike case. Since we have some time now, let's look at Nike. Everyone knows Nike, so this is a case question. All right. So you are Andy, who is doing a summer internship. So you are tasked to determine the. Okay, so this is not valuing the firm yet. This just is a bit more simple. Right? You want to determine the cost of capital for Nike. So you are Andy, you immediately gather some data and you explain your assumption in working out the cost of capital for Nike. Okay. So we have our income statement here. We have our balance sheet here. So these figures are picked from our SEC filings. All right. So we have all our standard stuff, gross profit, net income, earnings per share, diluted earnings per share, our balance sheet. Oh, do you see here? This is something you take note. See, can you see operating leases rights to use? So we do not really use operating, and this is under your total assets. So it's not part of your lease expenses anymore. Operating lease expenses is a part of your right to use asset, which is categorized as a asset. This Nike case is actually part of our, yeah, you can download from our T group. Yeah, right. Can you see there's also lease liability, operating lease liability? So even in this Nike, they have also adopted the FRS, which recommends you to, can we just zoom bigger, to recommend you to use recommend you to capitalize operating leases already. So in this case, you need not do any capitalization of operating leases. What else do you give? So based on the Nike 10K filing, we know that these are the various share outstanding as given here. What else? We do have, so based on Bloomberg, right? We have, because this is a question, so you give all the information, so that's a good thing. They give you some various treasury yields here, right? 3 months, 6 months, 12 months, 2 years, 5 years, 10 years, 30 years. So these are your coupon rates, these are your yields. So just be careful what you're using. Don't use coupon rates. You're using yields, yield to maturities. Okay. Okay, so this is what Andy is doing in this question. So what is Andy doing? So Andy says, if Nike is funded both by debt and equity, I want to use the WACC method to calculate the cost of capital. Based on the latest consolidated balance sheet, the debt and equity makes up 24 and 58% of the total balance sheet respectively. This is the one. So question, is what Andy doing correct? And why not? Okay, immediately you can see use market value. You're right. So you should use balance sheet figures, right? Okay. So let's see the answers for this first part. So we go part by part, right? Okay, so methodology, calculating cost of capital. Any method to use the historical debt and equity figures is incorrect. So you're right, use market value. Book value are historical and does not incorporate forward-looking and market nature of calculating the cost of capital. However, it's worth noting that many analysts use balance sheet figure to in lack of market information, especially for a private company. So we mentioned about this idea of private company, right? But in your case, it's all SGX company, so you have no reason not to use market values. So if you're going to use book values for calculating your cost of equity, not cost of equity, your uh, debt and equity figures, you'll totally be wrong. You'll receive zero for that. So in this sense, we use FactSet. I last time you had access FactSet, but now you don't have access already. But you can use anything. Capital S&P Capital IQ, very similar, right? Based on FactSet, market value of debt is this. By taking the current amount outstanding multiplied by the market price. Remember, we talked about how we calculate the market value of debt today. So we just take the current outstanding multiplied by market price. So let's just scroll down. So this is just a screenshot of where we get the values. So outstanding market price. Yeah, you're right. Some do not have. So if you do not have it, you can either try to approximate, or well, you got to try to approximate. you what else can you use? Yeah, you can't use anything. Yeah, you got to approximate. Yes, you can use a synthetic method of CDOs. That's okay too. Okay, okay. In this sense, we have all our debt. So we have calculated market value here, and then we take the summation of your market value. So, yeah. Okay. Similarly, for market value of equity, we take the number of Class B shares outstanding, which is on the balance sheet, multiply by the current share price. So this is the current share price here. And so the weight of debt and weight of equity is given by 6% and 94%. So I hope you can see that immediately. Let's go back to what Andy did. This is so different from just using book value. Totally different. So this is a major mistake that Andy has done. Okay. The next thing, to estimate the cost of debt. So for in this case, um, I use the total average interest expense. Okay, this is very common. Use the total average interest expense for the 3 years divided by 90 average long-term debt for two years. This rate is close to the average for 12 months and 2 years US Treasury yield, which is in line with my forecast horizon. Okay. Any comments for this first part? What's right and what's wrong? Yeah, okay, you're right. So yes, you can use cost of debt using the easy interest expense divided by the long-term debt. But in a sense that you have access, because it's a public firm, right? So you have access to yield to maturity. Shouldn't you use the yield to maturity? So I hope to answer your question. So yes, you can use cost of debt, the simple method whereby interest expense divided by book value of debt. Yes, that's right. But if you have more relevant data, like yield to maturity, then you should use that. So you can use the interest expense divided by book value of debt in the case of private firms. Maybe you have not much information, but even nowadays, if you look at private firms' financial statement, they do give you the interest charged by each debt. They go by SOFR plus 1% or 2%, 1% below, 2.2% or 3%. So you know that your interest is your SOFR, which is 24% plus 3%, 7%. So you actually there is very limited reason to use the interest expense divided by book value of debt. Okay. For private firms, maybe there's a stronger justification to use that method. But for private firms that you are analyzing, you need to use you need to have very strong reason to use this simple method. Maybe because the debt price is not available or whatever, right? There must be very strong justification. But if you have yield to maturity, please use yield to maturity. Yeah, that's right. So even private firms, like even for me, when I value private firms, I don't really use that as well because I use the okay. So nowadays, right, for especially for Singapore firms, they will disclose the debt, the number of debts, and for each debt, right, whether it's a working capital loan, whether it's a bridge loan, they'll let you know what's the interest rate of each loan. So there's actually no reason, no real reason to use that. Yeah, you're right. Okay, so yes, you pointed out rightly that you must use the yield to maturity. And this part here, this is a bit misleading. This rate is close to the average 12 months and 2 years US Treasury yield. What's wrong with this statement? Yeah, should be higher, right? It cannot be close to Treasury yield because if it's close to Treasury yield, then your debt is risk-free. Yeah. So doesn't make sense, and which is in line with my forecast horizon. Wait, so let's look at what's his forecast horizon. Oh, I think in the question, let's see. Yeah. What's the forecast horizon? Sorry, let's see. Ah, sorry, there's I understand company plan to hold the stock for 10 years. So there's a 10 years forecast horizon. Okay. So yeah, the treasury U one doesn't make so much sense. You use yield to maturity and check with synthetic. You're right. So let's look at the some of the suggestions here. Cost of debt. Okay, we should determine the cost of debt using the yield to maturity of the most recent longest long-term debt traded in the market, not the historical interest rate charge. You're right. So this is not the book value, right? Not the book value. Not I mean not book value. Not from the P&L statement. P&L. Not from P&L. It's worth noting that a few firms have straight bonds that are widely traded. So in this comment, what does it mean? It means that nowadays, right, a lot of these kind of bonds, they are convertible bonds, and I think not maybe some of y'all have experience on how you calculate um the straight bond price out of a convertible bond. So if you do know how to do it, use that method. In this module, we are not really going to teach you how to do it, but in case other modules you have learned, you can use those methods as well to calculate the straight bond price out of a convertible bond. Okay, but in any case, you can calculate the yield to maturity. This is a everyone should know at least how to do yield to maturity. All right, so yield to maturity in fat set is this. So this is given fat set lah. But in your own calculation, you have done the yield to maturity, and you calculate that is this. Can you see your value of your yield to maturity and the fat set value is actually quite similar. Fat set usually does fat set S&P capital IQ usually does some adjustments. So in your case, you just use a straight yield to maturity. That's fine too. So this is what I'm trying to say when you do comparison, right? When you do your valuation and you calculating all the components, do a bit of checks. Like, okay, you calculate at 3.59. Just check on the market intelligence tool that, hey, you know what, my number is about there, right? It's not super far off. Then you know you're on the right track, right? If you're due to maturity in that set, which is of course a big company, and then they have like professional analysts and all. If their value is 4.2 and you are like 3.59, you know you're off, right? You should be quite close to their number. And generally, right, if you dig deeper into the uh, market platform, the market intelligence platform, they would normally tell you how they calculate the number. So that will give you even more clues, even better. Okay, so there's a next part here. What's the next part? Okay, okay. Given the debt is tax deductible. Okay, that's true. What Andy did? Andy adjusted the cost of debt by the US statutory rate of flat 1% under the Tax Cut and Job Act in 2017. So my cost of debt turns out to be 1.2, 1.12. Okay, but that's okay. I see that the better. Okay, so this is a bit on tax really. So it's a bit interesting. So what happened? Okay, anyone know what happened in 2017 in the US? Anyone knows in terms of tax? What happened in 2017 tax? So it's not really that it's outdated. Yes, so there's a tax cut in this case. So what happened in 2017? So 2017, prior to 2017, if I'm not, okay, I'm not sure, around that period, I think it's 2017. Prior to this 2017 Tax Cut and Job Act in 2017, the US has a graduated, you're right, there's a major tax reform where it was a graduated tax of 35 to 21. In 2017, they did a flat 21%, which is very similar to in Singapore, is a flat 17%. Now, the important thing about this is that this is the tax rate, right? I think some of you are already working. You know that the tax rate taxed by the government is not the final tax rate you're going to get, right? It's not that you make $10, your tax rate is 10%, you're going to pay $1 in terms of taxes. I repeat again, if you make $10 of profit, if your tax rate is 10%, you're not going to pay $1 because, like some of us, or actually not some, all of us, we will have some tax rebate. This tax rebate reduces our effective tax rate. And that's why I saw a comment that you should use effective tax rate. You are right, but at the same time, not completely right. Why? Okay, so let's look at what the suggested solution is. Using US statutory tax of flat 21% under this is not appropriate as there's a tax deduction that's allowed. We should use the marginal tax rate. Okay, anyone know what's the meaning of marginal tax rate? So marginal tax rate is the rate of tax that you'll incur in the next bracket. Yes, incremental, the tax rate on the incremental dollar, next bracket, how much will you pay? So that is the amount of tax rate that you should use. Now, even in a flat case scenario, even a flat to a 21% or 70% scenario, your marginal tax rate might be different because of your tax deduction. Sometimes the more you incur, you get a bit more rebates, and therefore your marginal tax rate might be different. Okay? So in this sense, the best method, this is the best, I'm just going to the best, is to use marginal tax rate. However, in a situation where you have insufficient information determining marginal tax rate, our best case is to use effective tax rate, which is found in the SEC filings given here at 14%. So in your firm valuation, please determine what's the effective tax rate if you cannot determine your marginal tax rate, but do not use the flat 70%. If you use flat 70% for your Singapore corporate tax rate, you would lose some marks because that's not the right tax rate to use. Okay, so in this case, because we do not, let's say we're not very familiar with the US, we do not know what's the marginal increment of the tax per dollar, we use the effective tax rate of 14%. And so our adjusted cost of debt will be this times the 14% marginal. See, can you see there's some recovery of impact COVID-19? There are some tax deduction that's happening here. And also the US, usually there's tax loss harvesting as well. So what happens is that you can bring forward your tax losses, um, or when you have loss, you have rebate. So you can bring forward and to reduce your effective tax. So the US, there's a bit of more uh, tax thing that you can do to reduce your effective tax. What else? Let's look at the last part. Cost of equity. Okay, cost of equity. Based on my understanding, so and this understanding of the two methods of estimating cost of equity, I'm inclined to use the CAPM model instead of the discounted dividend model, given the superiority of the CAPM model. Understand company plans to hold the stock for 10 years. So because the company holds the stock for 10 years, if use the 30, I have used the 30-year US Treasury bond yield as my risk-free rate, the arithmetic mean for historical equity risk premium of 6% as my risk premium. And for the beta, I took the average beta for the last 30 years and found the average beta at 0.8. Uh, so if the company never give effective, so look at the financial statement, see what kind of tax rate they use. If they use a flat 17, then that will be effective. That will be flat 17. Yes, I use 10-year risk-free rate. You're right. You're supposed to use 10 year because that matches your time horizon for your investment of 10 years. Yeah, why is it 30? You're right. Why is it 30? Wait, I use interest expense divided by net income. What does that mean? Interest expense divided by net income. What does that give you? Interest expense divided by net income. Oh no, you cannot use that. Uh, tax expense divided by net income. Unfortunately, that will not be correct because um, there's some rebates and all. Try to look at the loose financial statement whether there's any comments on your tax expense and see how they calculate tax expense. Yeah. Okay, so one of the comment is on the risk-free rate, you're right, it should be 10. Okay. What any other issues here? Yeah, okay. There's a good comment here. Beta 10 years regression and beta 10 years regression beta but should some okay. So use the 30 years regression. Okay, some might not be too good. Um, some of you all have learned about Hamada's beta, so you can use that as well. Uh, Damodaran, you're right. So equity risk premium, you should use Damodaran. Do you learn that in these other modules also? Or you have reviewed this reviewed this case study. That's why you saw this. Oh, yeah, okay. Yeah, you're right. So, oh, the investment group is right, and they are teaching the right thing. You're right. You should use Damadaran. Oh, it's a team lead. Oh, nice. Yeah. So going in the right direction. You're right. Also arithmetic mean. This is an issue also. You should never use arithmetic mean. Because we are in finance, always use geometric. So let's look and see what are some solutions provided here. Okay, cost of equity. So Andy correctly identified the CAPM. Okay, CAPM is correct. That's fine. DDM is not so good. Okay, that's fine. Nothing much to talk about. Okay, let's look at here. Using the 30-year treasury rate as usual is not appropriate because our time horizon is 10 years. This one, immediately, some of you all already noticed this. Worth noting that the US bonds considered risk-free by market standard. Theoretically, the shortest, case important, shortest government bond, 3 months, is the most risk-free. Uh, but at the same time, not all government bonds are risk-free, right? For example, Brazilian is not risk-free. Okay. Even if time horizon is 10 years, the best is to choose 10 years. But at the same time, there's some market practice as well. People use 10 years as a considered risk-free for, let's say if you have a 15, let's say 12 years time horizon, 15 years time horizon, most people use the 10 years as a market practice. Equity risk premium, we should not use arithmetic. Please use the geometric, right, to take into account of compounding effect. Or arithmetic can be too overly optimistic in the long-term horizon. Arrow geometric is unbiased, okay. Okay, so the historical equity risk premium is also quite problematic because they're not captured forward. So you're right, the SUSS investment group mentioned correctly. Please use Professor Damodara's approach. And this approach is based on this. There is a, in case some of you all don't know what is that, you are not in the investment group, there is a link here. So please go into this link and read about this approach. So this is the right way to do your equity risk premium. Okay, copy and paste this link. You should be able to see a lot of details. Try to read about it. And this will give you your right way to calculate your equity risk premium, which I have calculated here. Uh, Historical 30 years beta again is not correct because you can use your Hamada's equation. If you have not learned about that, you can actually run a regression based on your stock versus S&P 500 to determine your slope, which gives you your beta. In case you do not want to do the running of the regression, okay, this one is just a comment here. It's up to you whether you do it. Of course, if you do it, it's quite impressive. You definitely will get bonus marks for that. But in case you don't want to do it, you can use what is given in FedSet, but please justify why you want to use data. Because in FedSet or in a lot of the platforms, they have a lot of data there. Raw beta, adjusted beta, levered, unlevered beta. So the question is, okay, should I use adjusted? Should I use unlevered? Because you should use unlevered because it's levered. There's 5 years, 3 years, yeah. So do some justification why you want to use that. There's this comment about beta being mean reverting as well. Okay. Okay, I know it's about time already. So the last part, basically, all those are the components for WACC, right? So now the last part is just to calculate a WACC. So first, not WACC, first calculate a CAT-N. Then you can calculate a WACC based on your various parts that you have formulated. And at the end of the day, your WACC, right, is close to the WACC provided by FedSet. So this is the track for you to ensure that you're on the right track. You're not like totally far off. If you're totally far off, means something is wrong. Okay. So there's a caveat here. In our case, we have taken the adjusted WACC, adjusted beta, but in the FedSet case, when they use the WACC, they have used a beta of 1.12, which take into account some adjustments, which we can see here. So, so this is a typical way. So note that suppose you substitute our beta with 1.12, our resultant WACC will be close to this, right? So this is there's a Greek philosophy, right, about this thing where you draw legs on a snake so that to say that a snake needs legs to walk. In other words, what it's trying to say is that you try to say that, okay, let's say I replace my beta with the beta that is given from the this fat set or S&P Capital IQ, then actually my answer is actually very close to the answer. It shows that my answer is actually very correct, right? So it's like drawing a snake and saying that it needs legs to walk, or not trying to say, drawing the legs on the snakes and saying the snake needs legs to walk. It's you can look at this analogy, but that's what I'm trying to say here, right? And then I somehow provided what is wrong with Andy's calculation. Okay, so I do see a question here. Does it requires historical data from analysts take the earnings per share? So his method, right, uses so go if you go into the link, right, and click there, there's two methods he used. The first method, I believe, is using the Moody's um ratings of the countries. Using those Moody's ratings, he uses the CDS, credit default swaps, to determine what is the swap rates for credit default swaps. And then he add this swap to the matured country risk premium to determine what is the equity risk premium. Something like this. This is the first method. Second method, he uses I can't remember, also a credit default swap, and then he adds the country premium or something like that. He takes an average. He can use the yeah, yeah. So I think some of your yes. So there are many methods. Generally, I think you use the CDS to calculate it. Um, whether it's historical data, not really. I mean, yes, it's historical because you use the 10 years or more. But at the same time, I think it's also forward-looking. Yeah. So usually this, even the swap, they usually base it on the mature country risk premium as a benchmark, and then they determine what is the spread, um, determine the equity risk premium. Okay. I know it's really about time. Okay, let me first pause the recording. Um, I think that's all I have to cover.